Welcome to Fun with Annuities, where every single week I welcome a celebrity guest expert that can help you maximize Chapter 2 of your life. Listen, learn, laugh, and love every minute of the most unique financial podcast on the planet. Let's get to it. Welcome to Fun with Annuities. I'm your host, Stan the Annuity Man, America's annuity agent, licensed in all 50 states. As you always know, I'm always, pushing myself out there as the source for annuities. And I consider myself that because I'm the brutal, factual walking middle finger of annuity truth. I'm proud of that. But one of my longtime friends in the business is arguably the top life insurance expert in the business. Been doing it for almost 50 years, even though he looks vibrant and young. He's been on the podcast before, but it's been a while because he's busy. But I wanted to get his insight on what's new in life insurance and have some conversation. Welcome back to the program, the infamous 6'8.5" Bill Black.
Thank you for having me, Stan. Good to see you again.
Is that the best introduction you've ever gotten?
It's one of them. One of the best, if not the best. Absolutely.
Another fun fact about Bill that I love is, number one, he in addition to being what I consider just it's not even arguable. He is in my opinion, the top life insurance expert in the country. He's also a triathlete. And I know he looks young environment, but he's getting up there in life. You're in Chapter 2, right, Bill?
Oh, yeah. Yeah, hard to believe. Hard to believe.
Are you staying uninjured?
Yeah, for the most part. I got a little bit of something nagging me right now, but for the most part, I don't suffer those injuries like a lot of other people because I am careful about it. Yeah,
you're flexible.
Don't overdo it.
You're flexible, man. That's good. Like I said, Bill's been doing this life insurance gig for a very, very long time. And Bill, if you were looking at today, at the time of this taping, people look at the date. What's getting your attention, or is it just the same old, same old? What's going on out there?
Yeah, what's getting my attention is life insurance. Well, somebody told me one time, not too long ago, that everybody uses their phone for everything but talking, right? You've got your music on your iPhone, you've got texting on your iPhone, you've got email you got shopping on your phone, right?
Sure.
Life insurance has kind of gone the same way. And so what's happening is you have these different life insurance policies now. You still have term insurance. That covers the risk for the smallest outlay. You're renting insurance, and there's not a doggone thing wrong with that.
Nope.
You got a need you want to cover that's temporary. Term insurance is the way to go. Don't be buying the high cash value stuff. But what has happened is interest rates have been in the floor.
Right.
How do we improve this? Well, one of the ways to do it is with these indexed policies. And so people are buying life insurance policies where the value that goes into it, the premium, goes into a cash value that is credited with, let's say, the Standard & Poor's 500 index or another index.
Do you like these, Bill? I know they're oversold and missold improperly in a lot of cases, but on surface, if you're telling people the truth about them, you're okay with them?
So here's what happens. You've got to buy the right policy. So you've got what I call institutional policies. You've got retail policies. In a retail policy, you hope you've got a cash value a year from now or 2 years from now.
Got it.
You pay a premium for every dollar you pay in premium, you might in the first year have a 20-cent cash value. Yeah, where's the rest of it going? Loads and fees and costs. Well, for those that are in business for themselves, right? There are institutional policies you can buy. And when you hear, and it's something that might be beyond the scope of our podcast today, but when you hear that these New York Stock Exchange listed companies are paying their executives, right, $20 million pensions and all that, it's really not a pension plan. It's done with life insurance. And these companies, you were in the stock market long enough, that if they pay a premium and there's no cash value, they take a hit to earnings, and earnings per share drive the value of the stock. They can't do that. So you're going to either have let's say, just to use a round number, 10,000, 100,000 in your bank account, or you have 10,000, 100,000 in the life insurance policy. Do you care? It's liquid either way. So
Right.
right now in your checking account or your bank account, what are they paying you? 10 basis points, 10% of 1%, it's an insult, right?
Some of them are. Some of them,
Yeah,
yeah, if you can shop it, but some of them, if they can get away with it, they pay that.
yeah. So in these life insurance policies, you've got cash value that's virtually equal to what you've paid in premiums. Now, because you wrap something around it called a life insurance policy, in many states that asset is now protected from the claimant judgment creditors.
Right.
Because of the way federal laws work, it's now actually working and growing for somebody without current taxation. Now you can access the money in a quote, quote, loan, so you don't have to pay tax on it.
And let's
And
start right there. Let's stop right there. That's where the fraud starts coming in from the sales pitches, because a lot of agents will say you're going to get tax-free income, and this is how the Rockefellers did it. That's the
mhm,
nonsense out there, right? On how
that
people are
is
pitching it.
that is the partial truth. Yes. Now let's talk about why it is the partial truth.
Yeah, I want to hear that.
Yeah. So when you borrow money, I don't care if you borrowed from your policy or the bank, it's not taxable, but
It's
it's
a
not
loan.
free. But it's
It's a
not
loan.
free,
Right.
right? And so you've got to pay the cost of that loan. Well, what people aren't told is when that they borrow from the cash value of the policy, they never told you need to pay the interest in cash every year. So they don't think they're paying anything,
Yeah.
but that interest is being paid out of the cash value of the policy. So if these policies get overloaned, in other words, the principal that one has borrowed plus the interest on that loan exceeds the cash value of the policy, which it can, and sometimes pretty quickly, that becomes a forgiven loan because the policy collapses under its own weight. Well, what does that mean? So what, right? Well, wait a minute. Forgiven loans are taxable as ordinary income
Ouch.
in the year of that forgiveness. So if we had borrowed 500,000, $1 million out of this policy over a number of years, and the accrued interest could double that,
Hmm.
right? All of a sudden, you're going to get a 1099 for a number that you were never explained, right? And that's where the nonsense comes in on this. And a lot of people that are pitching these don't really give that full explanation where, yeah, it's tax free. Yeah,
Hmm.
it's a loan, but you know what? If we don't manage this right, if it gets overloaned, some of these policies have an overloan protection rider on them, but still, you got to be very careful
Yeah.
with these. Some of these policies, they show you that the premium is guaranteed. And as long as you pay the premium and this and that, the policy is guaranteed it's not going to collapse. But if you read the fine print, it says if that premium is paid as illustrated. So let's say that you're paying, I'm just going to use a number, say $5,000 a year every year on the premium due date. Well, let's say I don't pay 5,000 this year, but I pay 10,000 next year. Or I pay 10,000 this year because I don't want to pay 5,000 next year, right? Well, that's not really as illustrated. And that policy can lose all its guarantees because of that one
Wow.
premium payment. Yeah. So not all of these policies are that way, but some of them are. So you got to be really careful when you're looking at this. But, get back to, life insurance is being used for a lot of reasons other than life insurance. This
Hmm.
is where you could start to do some things that are beneficial, but at the same time, you make sure you do it right with the right structure, so you're not just buying some retail product off the street that is a round peg in a square hole or a square peg in a round hole, as the case may be. Because sometimes people, advisors, agents, whatever you want to call them, will just take the highest commission product
Sure.
off their
Sure.
shelf, and that's what always grates me is they're looking at, where am I going to make my most money? What you want to look at is what's going to solve the client's uh,
Bingo.
need and solution. And
Bingo. And that's the
right,
reason that Bill Black's the only person I even point anyone to life insurance. He's my sole referral source because
yeah,
I know him. We've been on the speaker circuit together a long time ago. Um, he just shoots it straight. He's one of those guys, and he's going to have. You can go to my site after and look at Bill's bio, and we're going to put up, all of his links, etc., so that you can contact him. And what he does, which I think is cool, is he'll take a look at the policy you have currently and give you an honest, non-sales pitchy, non-agenda truthful, factual, brutal assessment of what you have, tell you if you need to keep it or tell if you can upgrade it, you know, in a moral and ethical fashion. If you can, he can do it. But that's the reason I bring Bill on. A lot of my clients, a lot of people that listen to the podcast and my videos, you know, they need life insurance advice. And he's kind of like me. He represents all carriers. He has no bias on, like, he there's no skin in the game. He's not going on some, you know, trip to Bora Bora if he sells enough of something. He's looking at what is best for you. And even if you need it, you know, in a lot of cases, and even if you're being pitched to sell your policy, life settlement type stuff, he's an expert on all of that. Bill, I have a question. I was dying to ask you this because in our industry, just to give you some people some background, the index universal life space and the index annuity space, a lot of the bad sales pitches revolve around what's called back-tested numbers. In English, they'll say, well, Mr. Jones, if you'd owned it 10 years ago, you would have gotten this. Look at these incredible returns, Mr. Jones or Mrs. Jones. Well, that dog does not hunt, obviously, as they say in the South. And we're having some issues in the industry, which is good, of saying, should we do that? In my opinion, we should not do that, or there should be regulations on how those numbers are shown. Explain to people that side of the life insurance side, and I'll finish my little comment with this and then throw the ball to you. As I say to people all the time in the annuity industry, and it dovetails into life insurance, if it sounds too good to be true, it is. Okay, so don't be falling for the sales pitch. So what's your take on the back-tested number argument going on right now on the life insurance side?
Yeah, it's like the annuity side. You know, historical returns have nothing to do with future expectations. And
Amen.
So,
Amen.
Yeah, and one of the things that you've got to be careful about is the indices that are being used. For example, some people will put in overseas indexes. Those indexes haven't done anything for the last 10 years, right?
Yeah.
The other thing is these are often point to point. And so,
and what that means to people is like, that means contract anniversary date to contract anniversary date. That's you. In other words, 364 days a year, you can't do anything. But on that 365, you can lock it in. That can be both good and bad. So that's what point to point means.
That's exactly where I was going. And so that's really what, but you know, here's the other side of it too. They're good in the respect that you don't have to worry about what to buy and when to buy and what to sell and when to sell.
Correct.
If you have the type of policy that had other type, you know, and then today interest rates are so low that it's like, okay, what am I going to do? Let them pay me 2%. So there's good and there's bad, right? There's not the silver bullet as in everything. But the other thing that you've got to be careful about is how that index is measured. I had a policy come across my desk that it really, you would think, hey, this is great. It was a daily point to point. In 10 years, from 2008 to 2018, that policy earned zero. Now stop and think about that. 2008 was the bottom, and that market tripled since then.
Right.
And just because of the way that index was, the policy earned zero. And you stand back and you go, wait a minute, what? And so these things have to be looked at carefully.
Sure.
But the other thing is,
let's stop right there, because what people say, wait a minute, that makes sense. A lot of times with these policies, both on life insurance and the index annuity side, they'll have a cap on the upside, but no cap on the downside.
There you go.
And the no cap on the downside is the part that most agents either don't know or forgot to tell you. But that's the reason that the monthly sum on the index annuity never works, because the caps on the upside is 3, but no cap on the downside. Same reason for the life insurance side as well. You've got to have experts involved in the process if you're buying these types of products to explain the good and the bad, the limitations and the benefits. As reading Bill's on the program, is because don't just buy what they're saying at the sales pitch, okay, or at the seminar, at the chicken dinner seminar. You've got to dig in, and you've got to have someone really weigh in on what you're buying. So keep going.
Yeah, so that's very prescient, because it is exactly that. You're digging out of a big hole when there are not capping the downside, and they're limiting the upside to 3, 4, 5, even
Sure.
12%. When you got a down year that's 20 or 30,
Yep.
you gotta earn 40 the next year to break even, right?
Sure.
So there's a lot of different things here that have to be kind of measured. And when you're looking backwards, okay, so the last 10 years, who cares? Last 15 years, that doesn't mean what's going to happen in the next 10. So one of the things that happens to people, as you see, is they've got a life insurance policy. And for whatever reason they bought it, that need doesn't exist anymore. I'm working with a client right now that had a 20-year level premium term life insurance policy, and they don't need it anymore.
Right.
What are you going to do with the term policy? You're going to walk away with it. Okay, so I paid, this particular client paid $2,000 a year for a $1 million policy.
You can
And
sell
Bill,
that puppy. You've taught me that.
that's exactly what we're doing. So what are you going to do? Have all those years where you pay those premiums and get nothing back? The insurance company keeps all that money. What we did is we said, okay, let's see if there's value in what is known as the life settlement market.
Sure.
And so what we did was we took it and we valued it, and we are getting him cash for that policy. Now, how in the world does that work? Well, you've got these big institutions like hedge funds, as an example, and they want non-correlated assets. What does that mean? Something that's not correlated to the stock market. Oh,
right.
Stan, you should diversify your portfolio in consumer goods and energy and blah, blah, blah. Well, when the market goes down, everything goes down, right?
Absolutely.
And so these guys take part of the hedge fund and they buy life insurance policies because mortality is independent of the stock market. And so what they do is they collect the client's medical records. They determine an LE or a life expectancy. They look at what the premiums are that they've got to carry, and they're going to come back with one of two things: no offer, because you know what, your cash value is as good as, or they're going to offer you a value in excess of the policy's current value.
Right.
So you can't do worse. The worst you can do is what you have today. But when one's life expectancy is now this particular client's in his 60s, okay, and what is the buyer going to have to pay in premiums? What is the expected return, life expectancy? And it's just a present value calculation. And why not put money in your pocket instead of just surrendering it for the surrender value?
And what Bill just described, and we're out for dinner a while back, and he goes, Stan, in essence, these are called death bonds. They're buying, they're death bonds. They're calculating your death, they're paying the premium, and they're going to collect the death benefit. That's the reason that you see a lot of commercials on TV, people wanting to buy your policies, and they're singing, and there's opera singers singing it. I'm not going to give them the airtime because they have enough money, but that's the reason they're buying it. They're buying the death benefit. And as Bill Black said a long time, he said two things to me that I've never forgotten. I've repeated many times. The first one is, one out of one of us is going to die, which is one of the more motivational things I've ever heard. And then the second one is, life insurance is the best return on investment you'll never see because you're dead.
Yeah.
Both of those are true. And it kills me, not literally.
No pun intended.
No pun intended. It kills me when people say, I'm just got to get my arms around the ROI on the ROI. There's no ROI until you die. But as Bill always says, that ROI when you die is really, really good. And when your beneficiaries and family members run it, they're going to, man, boy, we hated him or her, but man, were they savvy.
Yeah. Well, life insurance is liquidity, right? And I don't care if somebody's worth, $5 or $500 million. Most people don't have a lot of liquidity. It's in real estate. It's in the value of their business, et cetera. And, the liquidity is what the life insurance gives us. But there are times that come when that particular policy one has, they just don't need or want anymore. Or let's back up a second. You got a policy like you were talking about a moment ago where it wasn't fully explained. And now all of a sudden the premiums are starting to go up. Wait a minute. No. I bought this policy with a 10, 20, 30,000 annual premium. What do you mean the company's coming back to me now and they want a 60 or an 80 or a 90,000? Yeah. That's the policy wasn't explained to the buyer properly. And yeah, the premiums are escalating, and yeah, it's unaffordable now. Those we sell all the time, and the institutional buyer will get it. Now, you see these advertisements on TV. You got to be careful. Yes, they
Yes,
are
you do.
legitimate buyers, but when you're not in competition, when these buyers know that you just called them off their 800 number, they will give you a lowball offer.
And
We
see if you
go out
take it.
there
Yep.
and well, yeah, I had one of these guys tell me, "Oh, yeah, people take $50,000 more than cash value and think they got a deal," when in reality, the value in that policy was hundreds of thousands
Wow.
above cash value, right?
Wow.
So what we are as brokers is we can go out there and shop all of what are known as the funders or the buyers for these policies. And we will get an offer, and then we'll bid that against other buyers. Oh, you know what? You offered me X. Well, I just got X plus 10%. Can you step up to the table? Yeah, well, we'll give you X plus 12%. Then, we go back and forth and bid it up to the,
I know.
highest number we possibly can. So, yeah, call those numbers on the
But call
telephone at your
Bill.
own
Bill, you've been
peril.
doing this 45
At your own
years.
peril.
Are you
Yeah, 40,
45?
45 years next year in February. It'll be 45 years.
45 years of on the
hmm
ground
hmm
experience in the life insurance game. Not only has he seen it all, he's forgotten more than most agents will ever know. So if you're looking for 45 years of experience to review your policy to a person that doesn't need to make another penny in his life like me, we're just doing it out here because we're good and we like doing the right thing, then you need to connect with Bill. I'm telling you, I mean, every single person that I've referred to Bill has been happy. I've not done, and I refer mean people to Bill sometimes. So, I mean, they all have been happy because they all have been told the truth about their policies. So if you have policies, if your family members have policies you want to review, if you're thinking about it, been pitched, something that really sounds too good to be true, you do need to run it past Bill, because one of the things about life insurance, if you buy the wrong product and you buy it based on a sales pitch, you might beat yourself. Tell me about life expectancy tables. We're coming out of COVID. Me and you are healthy, hopefully. But what did COVID do? What's the lingering result in the life insurance business with COVID?
Well, some of the things that are happening is life expectations, believe it or not, are starting to back up a little bit.
Back up meaning
And
higher or lower?
lower. And so instead of people, every decade, think about the 50s, then the 60s, then the 70s, then the 80s, then the 90s, right? Every decade, life expectancy stretched out a little bit. Cost of insurance went down. You're going to live longer?
Yeah.
You can collect less every year to pay the same claim. The insurance companies are holding on to the money longer. They don't have to charge as much. But recently, life expectancies have been kind of shortening up a little bit,
Is that because
strangely.
of, I mean, you're a triathlete, and you probably, flying on the same airlines I am. Is that because of the obesity issue in our country and the diet and the fact that people, 40% of the country is obese?
It's a little bit of everything. You've
Okay.
always heard medical breakthroughs are making us live longer. But now, the question is, what are we eating, right? So
No doubt.
I heard that when we pass now, a lot of people don't, I don't know if this is good to be talking about on this podcast, but don't decompose as quickly because all the preservatives in our body are, yeah, it's kind of
I
morbid
thought
when
the
you think
flame
about it,
would
right?
be higher because there's so many
Ugh,
chemicals in there. No?
ugh,
So
ah,
we're smoldering is what you're saying.
ugh. And then, yeah, how many people that we see that are diabetic, they have multiple
Yeah.
meds that they're on. So
Yes.
it's one of those things. So Um, and it's just kind of crazy. And the other thing that's happening in life insurance is there are fewer and fewer people in the business. Now, all life insurance really is two things. One, it's sharing risk. Okay. Some people say, you're betting I'm going to die and I'm betting I'm going to live. That's not it at all. When you pay the premium on your car, are you betting you're going to wreck it? No. You're
Yeah.
throwing X dollars into the pool, and the person that wrecks the car, and it's a sharing of risk, right?
Absolutely.
So
Absolutely.
is life insurance. And so how do you price a life insurance policy? Yes, it's the present value. How many years do I have to collect a premium before the person dies? But one of the reasons or factors that they use in discounting it is I don't have to collect 100 cents on the dollar because I'm going to have earnings on my money. Well, when interest rates went down to zero or close to it,
Yep.
believe it or not, a lot of companies just got out of the life insurance business, and they just said, you know what, we're just not going to offer uh, the guaranteed premium universal life policies anymore. We're going to have to raise our term rates. A couple of companies just wholesale got out of the life insurance business. And it's like, wow. And it's almost like the Great Depression area where the premiums, if you have a 10-year life expectancy, you're going to, collect 1/10 of the premium because there's zero earnings on it. So that's another thing that's been happening in the life insurance business, hence the reason to go from interest sensitive policies, as they're called, to the hybrid policies where they are uh, the indexed type, et cetera,
Sure.
more market based. And what you're doing with those type of policies, sadly, is you are taking the risk and putting it on the policyholder. So back in the day when you had a whole life policy, that premium was guaranteed and that
Right.
survivor benefit was guaranteed. And that's because the carrier knew, how to measure the risk. Now, when interest rates are zero, it's like, okay, well, here's how we can keep the premiums in line. We got to shift a little bit of the risk to the client, and that's now these market-based type of policies shifted the risk. So that's why you've got to be real careful with what it is that you have and how to manage it. Which goes to another thing that kind of grates me a little bit is on these type of policies, you're shown all these wonderful, beautiful, huge cash values
Yeah.
based on a
Yeah.
hypothetical rate of return.
That means
Well,
non-guarantee to all you people in the hinterlands out there.
there you go,
Non-guaranteed.
non-guaranteed. And so what happens is twofold. One, what you look at on the guarantees is not very pretty. And on the non-guarantees, let's say you've got $1 million policy and a $600,000 cash value, wonderful cash value, right? Well, you pass away, you get $1 million. Okay, I'll solve that problem. I'll borrow out the 600,000. Okay, we pass away, $1 million policy. Oh, well, wait a minute. You already borrowed 600. Here's 400 net to your beneficiary. What good is my cash value? So one
Correct.
of the things we say is life insurance really is not necessarily an investment. And I know I was talking about it as an alternative earlier, and in some cases, okay, there's a fit. But for the most part, when you're talking retail type of policies and you're buying it for risk coverage and liquidity, you want to pay the thinnest, smallest premium to get the most coverage.
Sure.
I always say I want to pay $1 to get $1 million worth of coverage. And, the other people are going, oh, you want the big cash value. So, okay, I'll pay $1 or $1 million on $1 million policy. I'm just thinking extremes, right? Well, neither
Sure.
one of them is realistic. So pare it down to where I want to pay the smallest premium possible to get the most coverage. So keep my cash value, Mr. Insurance Company. Give me the thinnest premium I can. You know
Yep.
what I'm going to do? I'm going to take that premium savings and invest it over the side in, let's say, an annuity. So now when I pass away, I'm
Sure.
going to get my $1 million survivor benefit plus the value in the annuity for the same dollar outlay. So my beneficiaries are going to get more. I got my insurance covered. And then if I have money in, let's say, an annuity and I access that, I'm not reducing my survivor's benefit. So you've got the money over here in the annuity structured where I've got a return
Sure.
on the money. My beneficiary is going to get that when I pass away, plus the cash in the policy, all for the same dollar outlay. So what really, when you stop and think about it, is that cash value doing for you? The other thing when you buy these policies that have non-guaranteed, super wonderful high cash values, is you start to look at it, there's a premium load on those policies of 5%.
You better
Now,
believe
how
it.
many people are buying a mutual fund with a 5% load? No, most people don't want that. So why are we doing that with a life insurance policy? Oh, wait a minute, Stan, that's the premium expense. Life insurance isn't free. There's also a mortality cost, et cetera, et cetera, et cetera. So when you really start to look at, I pay X and how much of X is really going to the bottom line, you start to back up and go, wait a minute now. And so this goes back to what you're saying is, yeah, it all sounds wonderful, but let's drill down a little bit and let's see what we're really buying. And you know what? What are we really trying to accomplish? That's where we always have to start. What do you want to accomplish?
Yep.
Why? And now let's do it at what's right for you. not the insurance company.
And Bill, I've always said, you own an annuity for what it will do, not what it might do. You fall under that same thing. You own a life insurance policy for what it will do, not what it might do. And that's where people make the mistakes. It's really, really that basic. And if you can just stay in that lane and then, talk to people like Bill and I that we're going to shoot it straight and tell you where the pitfalls are, where the limitations and the benefits of the policies are, then you're going to be able to make an informed decision. The other thing too, and Bill and I, this is what Bill and I really agree upon. There's never an urgency to buy a policy, annuity, or life insurance. The urgency is for you to understand what you're buying. You don't buy the 30,000 foot view sales pitch. You buy the contractual guarantees of the policy. And if that means you reading a specimen policy, then we'll provide the specimen policy, just like Bill will provide the specimen policy. What I want to do, the reason I like having Bill on is he's like me. He just strips away all the nonsense of people out there pitching life insurance, in his case, mine, in case annuities. And I always say that the majority of the people who are selling annuities, I have cowboy boots older than they are. And there's a lot of young bucks out there selling life insurance. They have no clue what they're doing. You got 45 years of experience. They're not even 45 years old.
Yeah. So let me switch gears a little bit, and you asked in the very beginning, what is new? Okay.
Yeah. What
I said was, it's just like your phone. You're using it for everything but talking, right? You're buying music on it. You're listening to you, blah, blah, blah. Okay. Well, what is one of the biggest problems we've had in the overall insurance industry in the recent past is long-term care insurance. Okay. Oh my gosh, the baby boomers are getting older and things are starting to happen. Things are starting to fall off, as the expression goes, right? Well, with long-term care insurance, you can't really measure actuarially, mathematically, price that policy, because every year we get older, we need more help, and costs go up, and you don't know how fast medical costs are going to go up. And so what do? They, being the insurance companies, come back to you and say, hey, you know what? We got to raise our rates this year. What? I thought this was a contractual policy. No, it's not. Read the fine print. And so they're either going to raise the rate, or you don't want to change your rate, then we're going to lower your benefits. Neither one of them is pretty. Okay. So where do you go where you don't have that nonsense? A hybrid life insurance policy. Huh? Okay.
Wait a minute,
So
Bill. Life insurance for long-term care? What are you talking about, Bill?
Exactly, right? So let's talk about how this works. Let's say we buy a life insurance policy for $500,000 survivor benefit. If I never use any long-term care, my beneficiary gets the survivor's benefit. With a standard
tax-free, probate-free. Just let's throw that in there.
And probate-free, right. Now, the other thing I left out with a long-term care policy, if I pay the premium and I never need long-term care, all that money's out the window. By hooking it to a life insurance policy, if I don't use long-term care, my beneficiary gets income tax-free and probate-free, the proceeds of the life insurance policy. But wait a minute, you know what? I need long-term care. I can get as much as up to 2% of the value of that policy for 50 months. So $500,000 policy, 2% of that is $10,000 a month, tax-free, for 50 months, which is over 4 years. Statistically, people last, 3 years?
When you can't do 2 of the 6 daily functions of life, I think it's the average is 3 and the maximum 7, which means you're going to die in 5, which, ironically, they price it right there.
There you go. And so what happens is you get that 2% for 50 months tax-free. Oh, wait a second. You don't need the whole 2%. You don't need the whole 2,000. You can take less, okay? And then that just, makes it last longer, right? So if you take 6% instead of 10%, you get the idea. It'll last 48 months. It'll last longer. Anyway, and so if we take that, it's a fixed premium, a fixed cost. They can't raise the rate on you if you buy the right policy. You get that long-term care benefit, and what we've taken in long-term care benefits reduces the survivor's benefit, right?
Right.
So if we take $10,000 a month for 10 months, we've taken out $100,000. And in this example, the survivor's benefit drops $100,000 to $400,000. It's still a lot better off. And you know how much more it costs? Not much.
No,
So
I think these policies are great because you can, in essence, kill two birds with one stone.
exactly.
Which leads me to my next question. It involves underwriting.
Mhm.
Annuities are guaranteed issue. Life insurance, there's some form of underwriting. Tell me
Yeah.
about that. Has that gotten more stringent, or is it kind of the
Yeah.
same?
Yeah, it's actually getting more interesting and it's a little bit easier now, right?
Why is that?
So, well, because we have all of the electronics. You've got the
Oh,
MIB or Medical Information Bureau, where every time you apply for insurance, there's a note put in there. You have script
okay.
check. So now when you apply for life insurance, they can go and see what medications you're on.
Nice.
Okay, Stan's not on any meds. Oh, well, Stan was on this
Spoiler alert,
antibiotic.
Stan is on meds.
Okay. Well, what if you're on meds and it was only an antibiotic? Well,
Right,
okay, no high blood pressure, no diabetes, blah blah blah, right?
right.
So they get a feel from that, and then they order medical records from your doctor because everything's in there. So we're going eventually to a point where you're going to take a blood test, and that's going to be about it. Yeah, still you have the nurse
And
come
so
out there and ask you
it's
the
gonna
questions.
interact and connect with everything out there digitally, confidentially,
Hmm.
hopefully. And then
Yep.
you're gonna get so that process is gonna speed up, is what you're telling me.
Yeah, it's getting less and less
Wow.
cumbersome, less and less cumbersome.
Because you were in the
So,
days of no FedEx, fax machine. You've gone through all machinations of
oh,
technology. You've seen it
yeah.
all, man.
Hmm. Oh, yeah. It used to be that if you went over a certain amount, you had to have a chest X-ray and a
Oh,
treadmill and all of this type of stuff.
oh my
So
gosh.
it's not really as bad as invasive as it was at one time. So because of our information is so widespread now, it does make it a lot easier.
Does
But
blockchain help with that?
well, it helps keep you
No,
private,
no, I'm
right?
talking about the blockchain. Does that help with the records and what's being kept record-wise so that it's accessible quicker? Blockchain
Well,
technology.
yeah, nothing's accessible without your signature authorizing the release, and then once it's
Correct,
released,
correct.
the carrier is going to protect that from being
Got it.
exposed. Sure,
Good
but
point.
one of the things I say to a client is, do you want the new modern insurance or the old style insurance? And they go, what? I want the new modern insurance. Well, a lot of clients have just death benefit only insurance, and you can exchange that policy tax free for a more modern type of policy with the long-term care feature. Well, how do you do that? Well, let's say you've got policy A. You apply for policy B, same survivor's benefit with a long-term
Sure.
care, and then you just tax-free exchange. There's a section of the Internal Revenue Code called 1035, and you exchange your old policy for the new policy. Now, the new policy has a long-term care rider on it, and because we transfer the value from the old policy to the new policy, there's very little change in the overall premium, very little. And
Oh,
so,
that's worth a review of your policy right
mhm.
there.
Oh yeah, and you know how we work. We say, look, this is your premium schedule now. This is the way it would be here. Here's the
Sure.
difference. Make a business decision on what's right for you. It's just that
Make a
simple, right?
decision on the facts of the
Yes,
policy,
right,
the
exactly.
math of the
Hmm.
policy. I mean, Bill's a math guy. I'm a math guy.
Yeah.
This isn't anything fancy. I always say my newest saying, Bill, is that, and I put financial services as the category, but life insurance, there's nothing fancy or complicated about, let's just say, life insurance and annuities. What's complicated are the people that are selling it. They
Yeah.
make it complicated.
Right.
This is the most basic decision, whether you're buying an annuity, whatever type, or life insurance, whatever type. It's simple. If you're
Hmm.
looking at just the contractual nature of the policy,
Yeah.
it gets complicated when the sales pitch starts coming in. There's no sales pitch. It's numbers. It's like Bill just said. Here's the difference. Here's the number. Doesn't make mathematical sense.
Yeah.
It's your money. Make your decision. There's no
Right.
sales pitch. There's no urgency. There's no timing. None of it. None of it. One last question, Bill, then we got to wrap it up. There's 12,000 baby boomers hitting age 65 every single year. I mean, every single day, excuse me. So
Hmm.
12,000 and counting baby boomers hitting 65. That demographic tidal wave we've discussed in the past off air as we're, trolling around Florida eating at barbecue restaurants. What we do sometimes. Does that demographic tidal wave of people looking for guarantees and looking for legacy and looking for these types of transfer of risk or shared risk products, is that pushing the life insurance companies to be more innovative? And the reason I bring that up is Goldman Sachs just did a survey, a study about potential new products coming down the pipe. You are the guy in the life insurance world. What are you hearing? What are you being whispered to about?
Yeah. So what happens, fortunately, is what consumers are calling for has a significant effect on the way policies are structured. So when you have a client or a policy, you know, that just won't sell anymore, and it won't sell because interest rates are so low and premiums are so high that they have to come up with a solution. Hence, the indexed policies, hence to the other type that are market-based, because they have to do something to keep rates reasonable. So yes, it does. The consumer does have a say in the way this works. And what I always want to do, though, is kind of like you're doing, is find what's right for the client and not the type where the risk is shifted to the client. The insurance company is offering insurance and what back in the day they used to call assurance. And we want that the insurance and assurance company to be shouldering that risk. I want to pay the smallest premium I can to get the maximum return if I'm just buying it for the protection. And most of the time you can do that with term insurance, unless you got a need that's longer than 10 years or 15 years or 20 years. Then you got to buy the premium. Well, what's that for? Well, you know what? Estate taxes, right? Remember back in the day when anything you owned over $1 million, the government was going to take 55% of it. Well, okay. Thankfully, they changed that. But now that law is going to sunset, and we're going to go back to a pretty hefty estate tax. And so one of the ways to provide the liquidity, as I said earlier, most people don't have a ton of their value in cash. It's in hard assets. Is the life insurance provides liquidity for your heirs to pay that tax.
No doubt.
And yeah, so let's say that you owe, just to use round numbers, $1 million in estate tax. What do you want? Liquidate $1 million and pay it? Or what if you instead bought a life insurance policy where that premium was maybe $8,000 or $10,000, $20,000 a year? You got to live a long time. You'll never pay in premiums what you're going to pay in the survivor's benefit, number one. And number two, you're going to stretch it out over such a long period of time, those premium dollars, that it's a lot better than waiting for your heirs. Because it's like, I always liken it to a toll to cross a bridge, right? You want to inherit those assets? Okay, pay the tax first. Oh, you didn't pay it in cash in 9 months? Well, interest is going to start to accrue to the Treasury. All these are ugly realities. And so this is a way for us to, to solve those family problems. And anyway.
As I tell people all the time, one of the things I tell people is, you might not consider yourself rich, but you probably are. And especially in the eyes of a politician in DC, you are rich. Now, a lot of us, and most of us, didn't grow up rich. So there's a transition you're going to have to make in life to start acting rich. And what acting rich is doesn't mean that you wear an ascot and drive around in a Bentley. What that means is you put people around you that are experts, that have your best interest at hand, and that you can go to for sage advice without having to learn that category. Okay. And that's where Bill Black, that's the reason I keep having him on occasionally, is because he needs to be your go-to person in the Rolodex for life insurance. Whether you bought it from him or not, he needs to be that person. He needs to be that person that your kids call, that your spouse calls, that whoever your executor calls, that you proactively call to look at what you have and to assess your needs and to see if a life insurance shared risk type policy makes sense for you. But that's the reason I have him on. That's the reason I have Jack Lindenberg on for pure long-term care stuff. That's the reason I have people on that I trust, that's been doing this for decades, that need to be in your inner circle. In essence, your board of directors for your retirement. Bill Black's that person. Now, he's a personal friend of mine. I trust him implicitly, period. He's a good person. But I'm going to encourage you to contact him for review of your policy, or if you just want to spitball some ideas past him, I mean, he geeks out on insurance. If you didn't hear the passion in his voice, I mean, this is what he does, man. I mean, when he probably even thinks about life insurance when he's on his bike in a triathlon, I'm assuming. But any last words for the consumer out there, Bill? Either positive or watch out for this, and then we'll close this thing up.
Yeah, you know how we work with your clients, Stan, is they're welcome to call us.
Sure.
We'll give them a complimentary review of their coverage. We're not going to charge for that analysis. We'll show them what they have, and straight up, you sent me a lady not too long ago, and I told her, you know what you have is fine. Stay with it. If there's a way to improve it, you know, we demonstrate that mathematically on paper. And the only thing we ask is if we bring you a solution, we'd like to be the one to implement that solution. But other than that, you know, we look at those analyses. We're not going to charge for the analysis. We're going to do that for your clients to bring them the value that you're offering them.
That's my guy, Bill Black. He's based in Winter Park, Florida, which is the nicer section of Orlando.
Yes.
He's in Winter Park, Florida, but he's national. So regardless of where you're sitting and listening to this, I mean, just give him a call. He can work with you, and he's definitely a straight shooter. So I appreciate everybody on all the major podcast platforms for listening to Fun with Annuities, and the aggressive people out there for watching Bill and I on the Fun with Annuities YouTube channel. Thank you for joining us. We'll see you next time.